Gold's elevation to a Tier 1 asset in the banking system is a massive change that will have significant implications going forward. Gold will now be used in the global banking system in ways we haven't seen in our lifetime, and will become a more relevant asset in the investment world. To understand how big of a change this is, we must look back at when it was removed from the banking system originally, and why it has come back now. The current global US dollar-based system was created in 1944 at the Bretton Woods Conference in New Hampshire. Gold was pegged at $35 an ounce to the US dollar, and other countries could peg their currency's value to the US dollar as well. This agreement was a huge benefit to the US, but had its challenges and weaknesses. The system in its original form began to break down in the 1960s, resulting from a massive increase in US dollars globally. The US, in effect, had created too many dollars when compared to the gold that they needed to back it. Other countries had begun to demand gold for their US dollars, because those dollars were not worth what the peg stated. By 1971, the US stopped pegging the dollar to gold at $35 an ounce, because countries demanded gold for their dollars and had depleted the US gold reserves. Ending this arrangement essentially let the price of gold float freely in the open market. Gold had been illegal for US citizens to hold since 1934, but in 1975 the US reversed this law, and it was once again legal for US citizens to own gold. January 1, 1975 was the first day of this change, and it was expected that there would be massive demand for gold as a result. But this didn't happen because at the same time, the Bank of International Settlements conveniently devalued gold's collateral value on bank balance sheets. This move effectively made it much more costly for banks to hold gold, and as a result, banks in the Western financial system sold their gold in massive quantities. This selling value completely crushed the expected increase in gold buying by US citizens. This policy devaluation of gold's value in the banking system helped to drive the price of gold down by almost 50% over the next year and a half, temporarily crushing the bull market in gold. However, continuing inflation problems in the US persisted throughout the mid-1970s, and this brought back buyers into gold. Investor demand for gold eventually took the price to a new high of $850 in 1980. But the impact of gold's demonetization by the banking system would be obvious to market watchers. Massive money printing over the next several decades would drive a stock, bond, and real estate bull market in which gold as an investment became an afterthought. Gold had been effectively removed from the banking system in 1975 and wasn't needed by investors anymore. Fast forward to 2019, and gold has once again been brought back into the global banking system. The BIS's Basel III agreement raised gold's status from a Tier 3 asset to a Tier 1 asset. This rule change would effectively remonetize gold and completely reverse what was originally done back in 1975. This move would now make gold just as valuable as other Tier 1 reserve assets, such as US dollars and US treasuries within the banking system. This move means that now banks, central banks, and governments, the biggest players in the world, will want to buy gold more than at any time in the last 50 years. This policy change was done with very little fanfare and virtually no business media coverage. Subsequent to this change, we have seen massive central bank buying, most recently in 2022 and 2023. This central bank buying has helped drive gold to a new current all-time high of $2,800 an ounce. This buying is very likely to continue. Another factor that is important to consider is that currently, the BRICS nations are in the process of creating their own settlement currency or unit using gold. The gold weighting in this unit ensures that gold will be backing payments when settling trade imbalances between these BRICS nations. This new arrangement will increase gold's usage going forward and should help drive the current gold price much higher in years to come. Western nations' central and commercial banks will be scrambling to accumulate more gold for this new reality. With the revaluation of gold and its possible new use in international trade settlement, it is likely that we will see a large change in the relative value between gold and hard assets versus financial assets like stocks, bonds, and real estate. Gold will rise and financial assets will drop in relation to one another. With the ever-increasing global conflicts around the world, gold's value and usage internationally will rise as well. Given the changes we've discussed, this is why we believe that gold will become an important asset in investment portfolios going forward. In order for investors to preserve their net worth and properly hedge the financial assets they own, they must have a portion of their portfolio in gold.